Hey, this is Sasha. Thanks for joining me in today's video. Today, what we're going to do is we're going to go ahead and check out the top 5 reasons people fail trading covered calls. I mean, it is a simple strategy, but a lot of the failures come from human behavior, and that's what we're going to go ahead and cover today. If you're interested in learning more about the covered call strategy, definitely check out the website TradersFly.com. This is where I see where and why people fail because, I do a lot of the coaching and I even coach people on trading covered calls. You can take a look here, trade with me for 3 months, covered calls. We put on trade examples and stuff together and we review them and oversee them together. And you can also look at trading with me for a longer time period and give you some more strategies and insights to really learning how this business really works and operates. And yes, there's also a course if you want to do it on your own. You can check out some of the courses on trading covered calls for monthly income. But let's kind of take a look at some of these reasons. I'll give you some thoughts and takes, and maybe you'll get away with some insight here, and hopefully you can avoid some of these things. So some of the reasons, again, these are not in any order, and there's many more than 5 reasons, but I've kind of picked out a few that I thought were fairly common and, that I typically see periodically as I work with people. So one of the things is not the same vehicle or stock or ticker symbol. So people, what they do is they go ahead and hop around all over the place. So sometimes you go in and you're trading one stock, then you hop around, do another stock. This just really doesn't work very well. So what normally you want to do is you want to repeat the process. And if you repeat the process, you're kind of better off, because a covered call strategy, what happens is you're kind of in here and you're looking for it to appreciate, right? But when you're looking at it this way, if I'm doing Home Depot, well, let's say I go in and here, let's start this way as I'm drawing on the screen. I might have a covered call strategy here as I'm going up, but I also keep doing it on the way down, just like a long investor, and I still do it on the way up. So how do I go ahead and really make this work? Well, I have to repeat the process. So this is, if I go ahead and do it this way, well, I might have a win right here, might have another win, might have another win, might have another win. Now I might have a loss. Now I might have another loss, a loss, a loss, a loss, a loss, a loss. Now here again, it's a win, maybe a third win, maybe a loss. So now as I start looking at it, as I start looking at 20 trades or 50 trades or 100 trades, now I can really start seeing, okay, well, what am I doing? But what people do is, here's what happens. They go in and they say, okay, well, I start trading covered calls here. Well, I lose. Now they start getting into a winner, and now I lose. And they switch vehicles. And unfortunately, before you get to a nice long run, you're switching vehicles. And then what happens is let's say you go into maybe something else, and now you're starting this one over here. And now again, you're losing right before maybe it starts taking off. And that's what happens. So instead, doing the same vehicle, here's kind of lows. So again, you start here, lose, but now you're going to get into winners, but you switch vehicles at this point, and that just doesn't work because the probabilities now don't pan out in your favor, because then what might happen, you might miss out these bigger runs. Okay. So doing the same vehicle over and over again can really help. So also different share quantity. Okay. So if you go ahead and 1 week you do 100, next week you do 300, next week you do 500, then again, you do like 100 or 200. Okay. What's going to happen is you might win on a few of these, but you lose on the 500, and now your probabilities are out of whack. Okay, so it just doesn't pan out and work out in terms of the statistics behind it, because the biggest trade here, you might actually have a loss on, and now that actually draws down and pulls down your whole profitability case. So not doing the same quantity is also not so great. If we look at it here in this stock, let's take a look at Nike, for example. Okay. And let's back it up on a weekly chart. Okay. So if here now, if I go ahead and I do a win, maybe a loss, win, okay, loss. Okay. Well, if I'm always doing 200 shares, that's great. But if I all of a sudden start going, okay, well, I do 300 here, well, that's a loss. That's a problem. Maybe I do 500 here. That might work out again. That's like fantastic. Cool. But then I do like 700 over here. Oh man, that's a big loss, and it can wipe out like 3 of those winners or something like that. So again, be very mindful of that, because that can be a huge issue there. Also, concentration of risk in one stock. Okay, so doing 500 or 700 shares, that all sounds good, but some stocks trend differently. So you might say, okay, well, here's one, FSLR, it's trending up, okay? Whereas you might have like something else like a Goldman Sachs kind of trending up, a little different behavior, or you might have Disney trending a little different. So why would I go ahead and, let's say I had a $10,000 account, why would I put 9,000 in Disney and just do, you know, all those covered calls? Instead, what I could do, you know, 100 shares to 200 shares in this stock. Okay, then I could do another 200 in another stock. So now I've got 200 shares with different stocks, different vehicles, moving differently. And now I'm spread out all over the place rather than one big trade all at once. Okay, that's a bit of a problem. Concentration of risk, one stock. Why would you carry around all your money in your pocket? You probably have some at the bank, some on your debit card, credit cards, checks. You know, you can have different ways and forms of money. Some in the PayPal account, some investment accounts, some in real estate. Money spread out all over the place, right? So you don't just go ahead and just carry around all your money in your pocket. If it falls out, that's a lot of risk gone, right? Okay, not selling into strength is kind of another issue. What some people do is they go ahead and sell the covered calls, you know, as it keeps going down. They don't hedge and protect themselves. But on the other hand, it goes up right here. And here's a bit of the issue that I see. Okay, so let's say this was going to be a winning trade here on Disney. Okay, because we're looking at the weekly. So let's say this would be kind of like a winning one. So you've got this covered call strategy and you've got it trying to move up. Well, the issue here now is it goes up. People go in and they close their covered call or the call for a loss. Okay, they say, oh, okay, and now the stock starts pulling back. It's like, why would you do that? You would have made money on the call as it pulls back. Let the trade do what it needs to do to work. Okay, don't just kind of hold off or stop it. Let it do its work, because then the stock's already stretched maybe, and that's the point of the covered call. Because if a stock is moving, you know, in these different ways, most of the time, you're going to be just fine. But in other cases, okay, so as long as that stock is kind of moving here, let's go this way. As long as it's kind of in this zone, you're fine. And if it's exploding to the upside, you lose your stock. That's just part of it. But if it's anywhere of the other ones, you're fine. So anyway, let the trade work and don't get too crazy into it. Okay. And sell into strength. And the other thing is stopping out. So this is part of it. It's like, oh, it's coming in. It's going right here as it's coming up. Oh, I'm gonna get stopped out. Oh, okay, I gotta get out. I gotta, and then it reverses. So it's a bit of a problem because people get stopped out and they're like, oh man, it just didn't work out. Or vice versa on the downside. Sometimes, let's pull up like another stock chart here. Okay, so this one's a little bit crazy. Okay, so as we go into here, covered calls. Okay, well, what happens is let's say you put on a covered call somewhere over here, it starts to pull back, you get stopped out. You say, oh, I don't want to lose much more. Okay, fine. That time it might have worked out. Other times, okay, what happens is you get in right here, you're running the covered call, but then it spikes back up, you would have been just fine. So let the trade work and do what it needs to do, depending on your plan. Now, if your plan incorporates a little bit of a stop, that's fine, but don't make them too tight to where you don't let the trade work or run. Okay. So anyways, these are some of the big issues that I see oftentimes with the covered calls. There's many more, but these are some of the ones to watch out for. You know, keep an eye on them. Not, you know, people hop around stocks. That's probably the biggest one. Different quantities all the time. Also another big issue, and concentration of risk all in one stock. Those are very common. The other ones are a little bit more, you know, subtle, and I see those periodically, but not all the time. So anyway, I hope that helps. If you're interested in learning a little bit more about working on covered call strategy, definitely check out the website there, and you can see the coaching where you can go ahead and trade with me for 3 months or so on working covered calls and that strategy specifically. You can also check out the course for trading covered calls for monthly income as well. Hope that helps. Thanks for joining me. Enjoy the rest of the week ahead, and I will see you next time. Take care. Bye-bye.